Hey guys, welcome back to FiscalVoyage. I'm Felix, and today's video we're gonna do a stock analysis on Huntington Ingalls Industry. I'm hoping I'm pronouncing that right. This stock was suggested by James. James is a great supporter of my channel. Thank you, James. And if you guys have a stock you would like for me to analyze next, leave a comment below with the ticker symbol and then the stock logo or the stock name and a quick description on why you think I should do an analyze on that particular stock. Again, if you're new to the channel, make sure you hit that subscribe button and let's get started with the stock analysis. Alright, so Huntington Ingalls Industry right now is going for $168.43. Some of the key metrics we like to look at is the PE is pretty low at 10.9. We gotta look at this based on the average. We just don't accept any PE. We look at the historic PE and compare that to the current PE. Dividend rate at $4.56, and earnings are expected to be $15.57. So the payout ratio is very good here. Yield is respectable at 2.69, which is still much higher than the S&P 500. So some key dividend metrics I like to look at is the 5-year growth rate here, excellent, 20%. So that's outstanding actually. And they've been growing dividends for 7 years with a payout ratio, like I mentioned, pretty low at 30%. Another criteria I like to look at is the dividend yield versus the historic average. And you can see here the historic average is about 1.52%, which is a four-year average yield. And the current yield is 2.69, so it does look like it's undervalued based on the yield. And you can see here in around September, October, the company had almost a PE of 3%. So that's very good there actually, based on its history. So let's look at Morningstar. Some of the key things for Morningstar. Morningstar gives it a 3-star rating. Some key metrics you can see here: revenue growth 8%. Compounded for the past 3 years. Return on equity percent, trailing 12 months, 33%, which is very good. And Morningstar gives it a fair price of 163, a narrow moat, and based on yesterday's close, is actually slightly overvalued based on the Morningstar fair value price. So we look at some of the financials. Interest coverage is very good at 8.9. You like to see this at 2.5 or 2 and higher. The higher the better. Debt to equity ratio, decent, 1.29. I like to see this at 1 and lower, but even 1.5 and lower is acceptable. Seeing how interest rate is so low, so borrowing, debt right now is pretty cheap. So 1.29 debt to equity ratio looks pretty good. Some other valuation things I like to look at: the PE, like we mentioned, 5-year PE average at 16.9, currently at 11.64. So it looks to be undervalued based on the dividend yield and the PE earnings. So that's very attractive there. Price to book also here, 5.29 5-year average, and right now at 3.66. So again, another indicator that looks to be undervalued. So overall, I'm liking this company so far. If we look at if we go here and look at the key ratios and then full key ratios data, we'll get this these charts. So what I like to do is I created a spreadsheet, which you guys could download the spreadsheet in the description below, which is rule number 1, the big 5 from Tim's Philtown. And basically, we look over the return on investment capital, the 10-year average, the sales, earnings growth, equity growth, and free cash flow. And then based on that, does it fit the rule number 1 investing criteria? So basically what I do here is just copy all this and then paste it into the spreadsheet. Again, you can download the spreadsheet in the description below. So return on investment capital, which is the number 1 indicator that Philtown likes, passes rule number 1 investing, which is excellent actually. It should be 10% and higher. So if it's 10% higher, grass is green, and obviously these are 15% 10-year average, 5-year average is 21, and the 1-year increase from 2018 to 2019 average is 25. So that's very excellent. The next thing you like to look at is the book value or equity growth rate. for the past 10 years, 5 years, and 1 year. And you can see here it's actually not that good. It should be 10% higher as well for each year, 10-year, 5-year, and 1 year. But obviously you can see here is 7.1% for the 5-year and negative 4.1% for the 1 year. So what I would do if you're interested in this company would look at the 2019 annual report and see why equity is down negative 4.1% year over year. So that's something I would look into and see why. Earnings growth has been growing very nicely for the past 10 years at 19.4% and 12.2% for the 5-year average. And again, negative 30% earnings growth from $19 to $13 a share. I would look at that in the 2019 annual report and see why that happened. So, that's some homework if you're interested in this company. Sales has been increasing. It doesn't meet the criteria of 10% revenue growth every year or higher, but it is on the uptrend, so that's positive. And then cash as well. Look into this. Why is it negative? But overall, it does look solid. It does not pass the rule number 1 investing, but that's okay. We can still make money off companies that don't pass this investment. The next thing I like to look at is the fast graph. Fast graph, you can see here the companies grew earnings very nicely the past 7-8 years. And you can see here it had a 53% growth in 2013, 32%, 22%, 45%. And this is how the company was able to pay out and grow the dividends at a 20% rate over the past 5 years. So that's excellent. I like this a lot. The only thing I don't like is very cyclical type of companies. Earnings is very erratic. It goes up and down. As you can see here, from 2012 to 2016 it's been growing very nicely, but now it's going up and down. You can see here it had a huge growth in 2018, 63%, but then dropped 31% in 2019. So again, I would look into why is that, because this company is very dependent on the U.S. government, Pentagon, because they create military chips. Did a quick review of the company, so they're very dependent on the U.S. government. So maybe that's why it's expected to be down. With all the things that's going on with the politics right now. So that's something to look into. It is expected to be down 35%, so from $4.23 or $15.61 earnings to $10.09 for 2021. But this year they are expected to be 18% growth rate. So that's very positive considering the economic situation we've all been through for 2020. So that's positive there. Forecasting, you can see here this is where analysts for 2021 has been dropping their forecast. Originally 6 months ago they had $13.75 and now at $10.09. However, the long-term growth looks very excellent for this company. You can see here one analyst is giving it a growth rate of 40%. I think it's possible. You can see the company was growing at 53%, 30%, 22%, 45%. So that is possible. I'll probably give it at a rate of around 20% to 15% for more conservative view on this. But overall, it looks good. It looks fairly valued based on the fast graph. The company looks solid in the sense that revenue is growing. The earnings was growing. Just got to look at why 2019 it dropped 31%. It's just something to look at the annual report and see what the CEO says and look at some of the metrics there. But the forecast looks good beyond 2021. So there might be some potential for a downturn. I think the company looks to be fairly valued at current prices. Some other key metrics: S&P credit rated of BBB+, which is investment grade. Long-term debt to cap, as we saw in Morningstar, the company does have a good balance sheet, and the debt to cap ratio is decent at 55%. I like to see this at 45, 50, and lower. What else we like here? The dividend at 2.69. Overall solid company. It is undervalued based on the normal PE. As you can see here, a PE of 10.9 versus a PE average around 15. But again, if 2021 earnings is at $10.09, this PE would drop obviously based on that earnings. So it could potentially the company just stays flat for the rest of 2021. or they have a good quarter, they up the earnings, and then it could just start going up to $261. I personally think the company looks fairly valued now. I would like it to be at around 160 to 150 and 160. I think that's a good buying position, but it is a good company, and even if you were to buy shares now, it wouldn't be a bad buying opportunity. I just wouldn't go backing up the truck on this because it looks to be fairly valued, but good company at fair price is still a good opportunity to purchase shares. So again, you can get the rule number 1 investing chart in my description below. But overall, I think the company is good. I like it. Thank you for the suggestion. I'm going to add it to my watch list. But I personally will wait for a pullback at around 150, 155 before I personally would be interested in buying shares. But even at today's price, it looks to be decent with a decent low PE versus the annual average. Some of the key metrics, as I mentioned, return on investment capital is very excellent, great return on investment capital. So they're making money on their investment, and the dividend growth has been tremendous. You can see here again, over 20% for the past 5-year average. Hold on, there it is. And you can see here they've been growing dividends at a very nice double-digit rate. And they actually beat the total annual rate of return of 16.7% versus the S&P 500 of 12.2%. So overall, great company. So there you have it. Those are my thoughts on Huntington Ingalls Industries. I think it's fairly valued. I personally would like to see it at $150, $155. But even at today's price, it looks like a decent buying opportunity. I just wouldn't go unloading it and buying a whole bunch of shares right now. Just maybe open a position, a few shares, so based on your portfolio size. But overall, it's a good company. I could definitely see this company going higher as time progresses, but right now I think it's fairly valued. Thank you for the suggestion. Again, if you guys have a company you would like for me to analyze next, leave a comment below. Let me know your thoughts on this company. Have you heard of this company, HII? And thank you for watching. Again, if you're new to the channel, make sure to hit that subscribe button and check out the free ebook as well as the free spreadsheet that I have in the description below. There's a link for it too, so you can download it and use it for your analyzing of stocks. So thanks again for watching, and I'll see you guys in the next one.